everyone. My name's Ethan Heisler.
I'm Van Hesser.
And this is Bank Talk. Van, it's been a great summer. Of course, now we've got the world coming to an end. Hurricanes, trade disputes, all these other things that are going on. India and Pakistan. World's coming to an end, Van. What do you think?
I certainly hope not, but given the angst in markets, a lot of people on edge about what the future looks like.
So I think that, if we think about where the problems have been lying, I hear a lot of things in the news media talking about corporates and talking about bank loans and financials and where they're going. I got to tell you, I really think that financials are just fine.
Yeah, I wouldn't disagree, Ethan. Depends on, however, what you define as financials, right? So if we think about the financial sector, we really ought to divide it into sort of banks and non-banks. On the banking side of things, and again, a lot of this has to do with how the industry was re-regulated post the financial crisis. I think risk in the banking system in the US is fairly modest at this point in this particular cycle. But a lot of this risk that I think in past cycles may have ended up on bank balance sheets now has gone back into another familiar place, and that is the shadow banks.
Right. In fact, we have some graphs here. We can kind of make that point. So if we look at this first graph we have, this is shared national credit commitments. And what you can see here is that you can see the yellow line is the U.S. banks, the blue line are the foreign banking organizations, and the red line are the non-bank investors. That would be your shadow banks.
Right.
And what you can see is that the U.S. and the foreign banks own the bulk of the shared national credits. So that's consistent with what you think, but you can also see that the non-banks have been growing. But what's notable is that when you look at this next graph, you see the share of the classified shared national credit. So, the regulators come in, they look at every loan facility, and they'll rate that pass or not pass. And if it's not pass, then they have something called special mention. And then after special mention, there's another grade lower, which are classified assets. Those are loans that are rated substandard, doubtful, or loss.
Right.
So the substandard, doubtful, or loss, that's the sum of classified shared national credits. And what you can see here is that if I looked at the percentage of non-bank classified assets, a percentage of their holdings of shared national credits, they now own 60% of all classified shared national credits, whereas the U.S. and the non-banks collectively, they own 40%. Look at where that was 10 years ago.
Right. So clearly, what's happened, right? So post the crisis, we know both the banks, both in the U.S. and overseas, have gotten more stringent in terms of their underwritings. I think that comes from directives from their regulators, right? And also a little bit of market discipline at work there, right? Where I think post the crisis, I think investors wanted to see better credit discipline exercise on the part of the large banks. It doesn't mean, however, that credit is not going to find its way into more highly levered or more speculative situations. And that's where we've seen the rise of the non-banks, as we showed in the prior graph, have stepped in and filled that demand. And maybe not surprisingly, that's where we're seeing some of the greater deterioration.
Right, but I do think that the concern that regulators have, Quarles has testified this before, his concern is that if there is a step back from the market, if all of a sudden the non-banks suddenly say, this investment is really not working out, we're restricting credit, these borrowers that were getting their needs met through the shadow banks suddenly come back to banks, and there's no place to roll that debt.
Right. Therein lies the problem. Right. So we've got a corporate America, which, depending on how you measure it, certainly significantly leveraged at this point in this cycle. You really need the banks to fire on their cylinders and the non-banks to fire on their cylinders to keep all this going. Any whiff of problem out there is going to cause a contraction in credit, and that then leads to recession probabilities going up, angst in markets, and that's where we find ourselves here post-Labor Day.
Yeah, but Van, do you know what causes that trigger?
What causes that trigger?
The Fed raising interest rates. Do you think the Fed's raising interest rates anytime soon?
It was an interesting about face on the part of the Fed. So maybe they saw something out there that that a lot of people in markets had not foreseen.
No credit cycle, Van, has ever happened when the Fed was lowering interest rates. Never happened.
Right. Well, now we're lowering rates
sure,
again.
Not sure where this trigger can actually come. If I'm assuming more debt obligation, but rates are ridiculously low,
right?
Potentially negative interest rates one day. Who knows? We'll be talking about that in maybe another bank talk.
Yeah.
But if that's the issue, I don't see the trigger.
Well, let's think about the other side of the equation. Actually, bigger part of all this is the consumer, right? So without doubt on the commercial side, we're seeing PMIs come down, recession probabilities going up, manufacturing, contracting. On the other side of things, the 70% of the economy that is the consumer sentiment remains high, credit is abundant. All of that feels relatively healthy.
Mm-hmm. I would agree. I think the consumer's in great shape. Unemployment rate 3.7%. Personal disposable income continuing to go up. Where's the trigger? And the Fed is lowering interest rates. So again, where's that trigger? Well, we can look at the last graph in our picture in the deck here. And so what you can see here is the blue line is the which we have here is the mortgage debt service ratio. So what I did here was take the amount of interest that you would be paying on your mortgage and divide that by personal disposable income. So you can see that has gone dramatically down since the financial crisis, which everybody's quite aware of. On the other hand, consumer debt service, and what is that? That's going to be your autos, student loans, credit cards.
Right.
That has gone up. But it's still not where it was pre-cycle. And again, I still emphasize the fact that there are a couple of things. Employment is low. Incomes are up. Interest rates are lower.
Wealth effect is up. Stock market is up.
And the banks are still restrictive on the way they underwrite loans.
Right. Interesting, because we've known through history that lenders have generally priced consumer loan risk well. It's commercial loan risk that has been mispriced. Of course, that was reversed back in 2008. And all of those changes post-2008 on the consumer lending side have taken root, and at least in the banks are still relatively restrictive in terms of who they're lending to. It all feels to me like it's a prime, super prime orientation with the banks. And yet I think even in the less than prime, the non-prime segments, there's still plenty of credit available. That's where, again, the shadow banks have stepped in largely and been the leaders in lending to non-prime customers.
And the problem is that the Fed does not regulate non-banks. So in terms of being able to turn off the spigot or tighten the spigot, the Fed doesn't really have as much of a control over this as they once did. And I can understand those concerns.
Yeah, they've almost pushed some of that back into markets, right? So markets will now start to restrict capital once they get a sense that things are not all that well.
But it's hard to really look at any of this stuff. And I know the media keeps making a big deal out of it because it sells newspapers or whatever, or electronic newspapers or whatever. But at the end of the day, when you look at this risk, it's hard to really say, what are you really concerned about? Something that we're not aware of has to happen. If it's war or some geopolitical risk like that, perhaps the trade issues, if they continue to prolong, maybe that does push us into a recession. It's hard to say, but short of something dire that we're not looking at, I could see us 12 months from now still looking and concerned about this stuff, but not really seeing any of the signs.
Well, I mean, interestingly, I think that the consensus is still that the global economy and the U.S. economy are going to be growing 12 months from now and 24 months from now. Are those growth rates coming down? Without a doubt, especially overseas, but also softening in forecasts we're seeing in the U.S. as well. Once you start to slow, I think you've got to be really careful from a fiscal standpoint, monetary policy, from a sentiment standpoint, because now you're starting to get into a thinner margin of error, and you can get a self-fulfilling prophecy easily with another shock or two or three. So we're getting into an area where I think investors are getting more nervous, bankers are getting a bit more conservative, and I think business owners are probably going to get a bit more conservative as well. All of that leads to a slowdown in economic growth. And a year from now, I bet we'll be talking more about that than we are today.
I agree with that. So is the ratings team, when they go out and look at banks, are they asking any different questions today than what they might have asked before?
No, I think we're focused on the things we've always thought about when we get into asset bubbles. So commercial real estate, very much of a focus. Agricultural lending, which we do a lot of ratings of smaller community banks who have a significant ag exposure. That's something that is front of mind today. But let's not overstate things. The fundamental performance of the U.S. banks remains very, very strong. I think it'll start to weaken a touch. It's very tough to make money in a flat yield curve environment. I think that's going to start to flow through. Loan loss provisions are normalizing. It's hard to imagine it getting better than where we are today, but do I think we're seeing material degradation of fundamentals which would lead to rating actions? No, we're not. We're nowhere near that.
So 10 years into an economic expansion, can Kroll bond ratings actually be put on watch for upgrade for financial institutions in this part of the cycle?
For sure. From our perspective, well-run banks who do the right things, make smart expansion and acquisitions, have sound growth strategies, and prove they can manage credit risk and keep risk concentrations relatively low. All of those things are positives for bank credit. And we're seeing a lot of that right now. Okay. I wouldn't say we're ready to, this is not the peak of the cycle. We're getting towards it. We're aware of where that might be, but I don't think we're there yet.
Could be an extended peak. So just before we close, I know we have a conference coming up.
We do. A terrific, very timely to the topic we're talking about, where we are in the credit cycle. We're doing it jointly with NYU and Professor Ed Altman, an absolutely A-plus list of keynote speakers and panelists talking about all of these issues, the strength of the financial system, what we're seeing in corporate credit, and what we're seeing in structured credit, both in the banking system and in the shadow banks. A one-day conference, September 20th, up at NYU, going to be a terrific event.
I think it's going to be great, Van. I'm looking forward to it. Well, thank you.
I'll learn a lot.
Okay. Well, thanks, everybody. You've been watching Bank Talk, and my name is Ethan Heisler.
And Van Hesser.
See you later.